Welcome to the Deep Dive. Today we're cutting through the noise to bring you the essential story from Truist Financial Corporation's second quarter 2025 earnings call.
That's right, ticker TRU.
For years, the story for Truist has, largely been about integrating their big merger.
The SunTrust BB&T deal, yeah.
But now management is emphatically saying that's behind them. So our mission today is to uncover, are they truly shifting gears, from integration to aggressive growth?
Exactly. What do the numbers actually say? And are there any maybe surprising strategic moves they're making?
Precisely. We're aiming to give you a shortcut to being well-informed on Truist performance and their outlook.
Distilling those lengthy calls into the nuggets that truly matter. Let's maybe start with a snapshot of the results.
All right, let's get right into the headline numbers then. For the second quarter, Truist reported net income available to common shareholders of $1.2 billion.
Which works out to $0.90 per share.
Okay, 90 cents.
Now, what's crucial to understand about that $1.90 is that it included a couple of non-recurring charges.
Ah, okay. Like what?
There was 2 cents per share in restructuring costs, mostly severance, from their ongoing streamlining.
Right.
And another 1 cent per share in losses from selling off certain investment securities.
Okay, so adjusting for those.
Well, even with those one-off hits, management characterized the quarter as solid.
Solid.
Which suggests a pretty robust underlying performance, largely due to the sheer diversity of their business lines and, frankly, how well they seem to be executing on their strategic growth plans.
So it's not just a solid quarter numbers-wise, it's like strategically solid.
That seems to be the message, yeah.
Okay, let's really unpack that then. How did the different pieces of their financial puzzle contribute? Starting with revenue.
Okay, revenue.
Mm-hmm.
Adjusted revenue actually saw a 2.1% increase from the previous quarter, or linked quarter, as they say.
Right, compared to Q1.
And this was mostly powered by a 2.3% jump in net interest income, or NII.
Okay.
And also a 1.8% rise in non-interest income.
So NII, that's the bread and butter. How much did that actually increase?
Mm-hmm. In real dollars, their NII increased by a substantial $80 million.
$80 million. And what drove that? Was it just loan growth?
Well, it was a combination. Strong loan growth was definitely part of it, yes. But also the repricing of fixed rate assets helped.
Ah, okay.
And believe it or not, simply having one extra day in the quarter.
Ah, right. The calendar always matters.
It does. And despite that solid NII growth, their net interest margin, or NI,
which is basically the profit margin on their lending, right?
Exactly. It only nudged up 1 basis point, just 0.01% linked quarter, hitting 3.02%.
Only 1 basis point despite the NII jump.
Yeah, it indicates they're maintaining a very tight balance between what they earn on loans and what they have to pay out for deposits and funding.
Okay, so NII is the primary engine. What about those other ways banks make money, like fees and services? Non-interest income.
Right. Adjusted non-interest income rose by $25 million, or 1.8% linked quarter.
Okay.
This got a big boost from an $83 million increase in something they call other income.
83 million, wow.
But it was partially offset by a notable $68 million. That's a 25% decline in investment banking and trading income.
Oof, 25%. Why the drop there?
Management pointed to early quarter market volatility. Things were choppy back then, and also just lower M&A activity, fewer deals happening.
Makes sense. And the other side of the coin, expenses.
Right. Adjusted non-interest expense increased 3.1% linked quarter.
Higher than revenue growth then?
It was this quarter, primarily driven by higher personnel expenses. Think annual merit increases and also some strategic hiring effort.
So investing in people could be good long-term if it pays off.
That's the idea, yeah. Investing in human capital.
Okay. But for a bank, it really all comes down to the core business, loans and deposits. Given the mixed signals in the economy, how strong was their actual loan growth?
Pretty healthy, actually. Average loan balances increased a solid 2% linked quarter.
Okay.
And end-of-period loans grew even more by 3.3%. That's $10.2 billion in new loans.
$10 billion. Was that concentrated anywhere?
No, it was apparently split pretty evenly between their commercial and consumer segments. Signals a broad-based expansion.
And they're saying it's driven by new business.
Yeah, significant year-over-year increases in loan production and, importantly, new client acquisition. Their lending pipelines, they say, remain very strong.
Okay, strong loan growth. What about the funding side? Deposits.
On the deposit side, average deposits increased by $8.3 billion, or 2.1% sequentially.
That sounds good.
But There's a key nuance here for you.
Ah, okay. Always a nuance.
Always. The company noted an impact from $10.9 billion in sort of short-term client deposits that were just sitting on the balance sheet for the quarter, but have since been withdrawn.
Oh, temporary funds.
Exactly. So if you exclude those, average deposit balances would have actually been slightly down.
Okay. That changes the picture a bit.
It does. But that said, a crucial metric here is the cumulative interest-bearing deposit beta.
Right, the deposit beta. Remind us what that means again.
Think of it as how much the Fed's interest rate changes a bank has to pass on to its depositors. So a lower beta means their deposit costs are becoming less sensitive to market rate fluctuations.
Which is good for their future profitability, right? Means they're paying less to keep those funds.
Precisely. And it declined from 43% down to 37% linked quarter. That's a definite positive.
Okay, lower beta, that's a good sign. So we've covered the growth engines, but every investor wants to know, how healthy are those new loans and what kind of cushion does the bank have if things get bumpy?
Right, asset quality and capital, let's hit that.
Yeah. How did asset quality look?
Pretty strong, actually. They maintain strong metrics. Both non-performing loans, those are the ones where payments aren't being made.
Right.
And net charge-offs actually decreased by 9 basis points linked quarter.
Both decreased. Okay. What about charge-offs specifically?
Net charge-offs hit 51 basis points. That's their lowest level since the third quarter of 2023.
51 basis points. And just to clarify, net charge-offs are the loans they've basically given up on collecting, right? The actual losses.
That's right. So seeing this number go down is like a positive health report for their lending book. Fewer loans going bad, which is always good news, especially now.
And their provision, the money set aside for bad loans.
The allowance for loan losses ratio actually decreased 4 basis points to 1.54% of total loans.
Decreased. Why is that?
They partly attributed it to an improved outlook for their commercial real estate office and multifamily portfolios. Seems they're feeling a bit more confident about risk there.
Interesting. Okay, and their capital position, how strong are they?
Truist remains in a strong capital position. Their CET1 ratio, that key measure of core capital strength, did decline 30 basis points to 11% linked quarter.
Down slightly. Why? Buybacks?
Partly, yes. They returned a substantial $1.4 billion to shareholders through dividends and another $750 million in common stock repurchases.
$750 million in buybacks.
And here's a cool detail. $250 million of those buybacks were opportunistic, meaning they jumped in when the market dipped early in Q2 to buy back shares at a better price.
Smart move.
And something really interesting for future flexibility. Following those favorable stress test results, they anticipate their stress capital buffer, or SCB.
That extra cushion regulators make them hold.
Exactly. They expect that will decline and be floored at 2.5% effective October 1st.
Which means?
Should provide them with even more capital flexibility going forward. More room to deploy capital, potentially more buybacks or lending.
Okay, good to know. Now, let's dive into the strategic moves management is emphasizing. They seem keen to talk about things beyond just the numbers.
They really are. The company really highlighted its purpose to inspire and build better lives and communities as central to its entire strategy and decision-making.
Trying to embed it in the culture, sounds like?
Seems so. And they've been very active in talent and market expansion, welcoming new leaders, reinforcing their commitment to attracting top talent.
Where are they focusing?
Strengthening their presence in key growth markets, especially the Southeast, and expanding capabilities across high-potential verticals like payments, wealth, and premier banking.
So a clear signal of playing offense now. Fits that shift from integration narrative.
Definitely aligns with that narrative.
We mentioned the dip in investment banking and trading income earlier. What's the outlook there? Still weak?
Actually, it seems to be turning a corner. After the early quarter volatility and losses, that business apparently saw steady improvement in May and June.
Okay.
And they sounded pretty optimistic about a second half 2025 recovery based on their current pipeline and activity levels.
That could be a significant tailwind for the back half of the year if it pans out.
Absolutely.
What about the bread and butter consumer and small business side?
They noted solid consumer loan and deposit growth there, plus positive net new checking account growth, nearly 37,000 new accounts, specifically.
37,000, that's pretty good.
And they're specifically succeeding in attracting younger, higher balance clients, which, aligns with a long-term strategy for building a stable, valuable deposit base.
Where's the loan growth coming from in consumer?
Residential mortgage, indirect auto, and other consumer loans, particularly through their Service Finance and Sheffield platforms.
Okay. And on the bigger side, wholesale banking.
They experienced growth from both new and existing clients there too, particularly strong in financial institutions group, energy, middle market lending, and structured credit.
Middle market seems like a focus area.
Yes, they highlighted a strategic focus on capturing more of the middle market. And get this, they noted they've attracted twice as many new corporate and commercial clients year to date compared to last year.
Twice as many. Wow, that's a powerful sign of gaining market share.
It really is.
And wealth, how's that doing?
Wealth saw positive net asset flows even with volatile markets. They had a 27% increase in year-to-date assets under management coming from wholesale and premier clients.
27% AUM growth. Nice.
But here's where it gets really interesting, I think, on the payments side.
Okay, what's happening there?
Truist became the first financial institution to prove requests for payment over the RTP network. That's the real-time payments network, using an alias.
An alias? Like what?
Like a cell phone number or an email address instead of complex bank account details.
Ah, that makes it much easier for businesses, right?
Exactly. This innovation is designed to unlock meaningful value. It can accelerate cash flow and massively improve reconciliation for their clients.
That sounds genuinely innovative.
It is. And this specific enhancement, they said, contributed to a significant 14% increase in treasury management revenue year over year. It's a foundational shift in how they're approaching corporate treasury clients.
Wow, that's a huge step forward for them. So beyond this specific payments innovation, what other evidence are you seeing that really points to their overall digital momentum? Are they truly transforming?
Well, they're reporting strong progress, generally in digital platform integration, engagement, and importantly, production.
Production meaning?
Digital account production, like opening accounts online. It rose 17% year over year.
Okay.
And get this, a remarkable 43% of their new-to-bank clients actually joined through digital channels.
Almost half. That's significant.
It is. They also fully integrated Lightstream lending products under the Lightstream by Truist brand. And over 1.88 million clients are now using their digital financial management tools.
How does that compare?
That's a 40% increase year over year in usage of those tools. That's a massive amount of digital engagement.
40% increase. Wow. Okay, so given all this momentum, this strategy, what does it all mean for the future? Let's look at their guidance, Q3 and the full year 2025.
Okay, guidance. For the full year 2025, the revenue outlook remains unchanged. They're still expecting an increase of 1.5% to 2.5% versus 2024.
Okay, stable outlook there. NII.
Net interest income is still on track to increase 3%. But there's a slight change in assumptions here.
Oh.
This now assumes low single-digit average loan growth and only 2 25 basis point Fed funds rate reductions, one in September and one in December.
Down from 3 cuts they assumed before.
Exactly. So a slightly more conservative view on where interest rates are headed this year.
And non-interest income.
Expenses.
Non-interest income is expected to remain relatively flat for the full year. Adjusted expenses are projected to increase approximately 1%.
Okay, so revenue up 1.5 to 2.5%, expenses up 1%.
Which implies positive operating leverage of 50 to 150 basis points, meaning their revenue growth should outpace their expense growth for the year.
That's the goal. What about charge-offs for the year?
Net charge-offs are guided to 55 to 60 basis points. That's actually an improvement from their prior guidance of around 60 basis points.
Okay, slight improvement there. And what about the next quarter specifically, Q3?
For the third quarter, they anticipate revenue to increase approximately 2.5% to 3.5% linked quarter, so accelerating from Q2.
Okay, driven by?
NII is expected to increase about 2%, driven by that loan growth, fixed asset repricing, and again, an additional day.
And non-interest income is projected to increase about 5%, primarily due to higher investment banking and trading income, reflecting that optimism for a recovery we talked about.
5% jump in non-interest income. Okay. Expenses in Q3.
Adjusted expenses are expected to increase about 1% linked quarter. And they plan to target up to $500 million in share repurchases.
Okay. Another $500 million in buybacks, potentially.
If we connect this to the bigger picture for you as an investor, management asserted, pretty strongly I'd say, that their merger integration is fully behind them.
Finally.
Yeah, freeing up their focus for pure growth. They believe they are better competitively positioned than ever, particularly in that highly competitive Southeast market.
And they feel they can win new clients there.
They emphasize their ability to win new clients and deepen existing relationships, pointing to their product capabilities and advice model.
And going back to NI, that net interest margin, what's the outlook there? Still creeping up.
Management expects that positive trend to continue into Q3 and Q4. They have an eventual aim for the 3-teens area over time, meaning 3.11% to 3.19%.
Okay.
However, they're clearly emphasizing NII growth as their primary focus. It's a key distinction. It's not just about the margin percentage, but the overall dollars of profitable lending.
Volume over margin to some extent.
Kind of, yeah. Growing the whole pie.
This raises an important question about credit quality resilience, though. Are they seeing any cracks despite the good numbers?
Well, despite the macro uncertainties out there, the company sees signs of stabilization and resilience in credit quality, particularly they mentioned in commercial real estate.
Really? CRE?
Yeah, which they attribute to proactive management on their part, and also just increasing certainty in the environment as more deals get worked out and the path forward becomes clearer.
Interesting perspective. And their commitment to operating leverage. Are they confident?
They expressed high confidence in delivering that positive operating leverage. They noted that strategic cost savings are being strategically reinvested into growth initiatives.
So savings funding growth.
Right, with top-line growth being the absolute key. And interestingly, they also pointed out that some of their digital investments are designed to be self-funding, which is a smart approach.
Yeah, digital paying for itself. And one final point on loan growth, is it just businesses drawing down existing credit lines?
Good question. They stress that the core driver remains strong production, especially from new clients and expansion markets, rather than simply increased line utilization.
So truly new business, not just drawing down existing commitments.
That's the message, which indicates they're genuinely bringing in new business, a healthier form of growth.
Okay, makes sense. All right, now for our This Is Not Financial Advice segment.
The fun part.
Where we pitch an outrageous but plausible trade idea like we're pitching the investment committee.
Okay, let's hear it.
The big idea here, go long Truist. But specifically, playing the highly specific digital payments innovation angle.
Okay, that RTP alias thing we talked about.
Exactly. The market, in its broad regional banking assessments, might be severely underappreciating the foundational shift Truist is making by being the first to offer these real-time payment requests via alias.
You think the market's missing it?
I think it might be seen as just another tech upgrade, but it's potentially a direct pipeline to stickier, lower-cost commercial operating deposits and, as they showed, enhanced treasury management revenue.
It's a nuanced point, definitely. Could provide a distinct competitive edge in a segment, corporate deposits, that's crucial for sustained lower-cost funding. Maybe not fully priced in yet.
Precisely. So the play. Consider a long position in TRU common stock. Maybe complement it by buying some out-of-the-money long-dated call options to capture the potential upside if this payments-driven deposit surge really takes off.
Okay, long stock, long calls.
And simultaneously initiate a small, highly selective short position in maybe another regional bank, one that has shown less explicit innovation or competitive aggression in digital payments or treasury management specifically.
So a pair trade, essentially. Betting Truist wins share because of this tech.
Yeah, betting that Truist is positioned to actively steal commercial deposit share due to this specific practical digital advancement.
A bold strategy. Hinges on a very specific competitive advantage playing out. It's certainly an interesting way to bet on their ability to execute on that digital lead.
Okay, let's recap our deep dive then. Truist delivered a solid Q2, definitely, driven by robust loan growth, improving asset quality, and significant strategic investments.
They're confidently targeting positive operating leverage for the full year and seem genuinely optimistic about a recovery in investment banking activities in the second half.
And their focus on digital innovation, particularly in payments with that RTP alias feature, plus their renewed competitive drive in key markets. It really does position them to continue building momentum.
It really feels like they could be shifting from that long merger integration phase into an era of more targeted growth.
As always, this discussion is purely for informational purposes only. It should not be considered financial advice. Please conduct your own due diligence before making any investment decisions.
Absolutely. So what stood out to you from Truist's latest call? What's the biggest takeaway for your own understanding? We'd love to hear your thoughts.
Until next time, keep diving deep.